Interest rates are at the highest level they've been in years, and that affects all aspects of your money, including savings rates, credit card rates, and mortgages. Recently, the Fed indicated that an interest rate cut might be coming in the near future. Here's what that means and how you can prepare your finances for potentially lower interest rates. During the Fed's July press conference, Federal Reserve Chair Jerome Powell said that rate cuts could be on the table as soon as September. When the Fed cuts rates, banks often follow suit and start slashing rates on savings accounts. If you think a rate cut is likely and want to maximize your savings, then opening a certificate of deposit account, also known as a CD, with a fixed interest rate before the rate cut might make sense. That way you will lock in the higher interest rate before rates go down. However, remember that with CDs, just as the rate is locked, so is your money. Many CDs charge a fee if you withdraw funds before the maturity date. This can result in you losing some or all of the accrued interest if you need the money earlier than expected. If you can't afford to lock money away in a certificate of deposit, it might make sense to take a look at your savings account. If rates do fall, shop around and make sure you're still getting the best rate on your savings. Different banks and credit unions respond to a Fed rate cut in different ways. Though the overall trend is to follow the Fed's direction, how much and how fast they cut rates could vary. So do your research to make sure you're getting the best deal and check back in a month or so to see where your account stands. If the Fed cuts rates again later in the year, you should compare savings account rates again. Prospective home buyers might welcome a rate cut. Lower interest rates eventually lead to lower mortgage rates, and that's good news for home buyers as it lowers their monthly payment. If you're planning to buy a house in the near future, you may want to wait a couple of months to see if rates drop. However, you shouldn't expect a huge difference right away. A slight interest rate cut may only make a small difference on your monthly mortgage payment. If, on the other hand, you bought your home in the past and your mortgage rate is particularly high, it might make sense to review your credit report and see if you should refinance your mortgage if and when rates begin to drop. An interest rate cut by the Fed could also lead to lower interest rates on credit cards. For borrowers with credit card debt, even a small dip can make a big difference. If interest rates begin to drop, call your credit card provider and ask if you're eligible for a lower interest rate. Many of these changes depend on what Wall Street analysts like to call the rate cut path, meaning how much and how fast the Fed will cut rates. Wondering if further rate cuts will happen later on in the year? That depends on several factors, including inflation and the broader state of the economy. If inflation increases, the Fed is unlikely to cut rates. But if inflation goes down, then another rate cut may happen. It's a delicate balancing act that the Fed has to master. So keep monitoring where interest rates are headed and adjust your personal strategy accordingly. If you need more specific advice tailored to your individual needs, you can always reach out to a financial advisor. And if you want more content like this from MarketWatch and the Explainomics playlist, please subscribe and keep checking back for new videos. We'll see you next time.